Welcome to the Master Certificate in Technical Analysis, Module 12. This module is about how to build a trading system, how to put in application the things that we've learnt about in technical analysis. So what are the features of a trading system? First, it has to be based on sound concepts. It has to be based on things that you've learnt in technical analysis about trends, about the way the market behaves. It can't be based on any offbeat things that works just occasionally. It needs to be based on something that has principles that you understand. Also, it has to have repeatable results. That really comes down basically on sound concepts. Obviously, you need to be able to test it in various markets. You need to find a trading system that is likely to give you the same sort of results in the future as it has in the past. The trading system is not sensitive to the parameters that you're using, so that if you're using indicators, oscillators, moving averages, you don't want to find that you're just change a parameter of one of them by a day or two and the whole system collapses because it's so highly tuned to the historical data that you've set it up for. So it shouldn't be sensitive to the parameter. That doesn't mean that you shouldn't try to adjust the parameters to get the best results. You can, but certainly you don't want something that would just fall down if you change your parameter by 2. An important point about trading system is that it must suit your risk profile. It's got to suit you. Some people don't mind taking a lot of risk, and other people do, and if you try and trade something that doesn't suit you, then you'll have an internal conflict. It'll be hard to do. So you've got to pick your way that seems sound for you. And of course, the trading system has got to suit the time that you have. If you're working a full-time job, you're coming home tired in the evening, you can give it maybe half an hour or an hour. That's different from maybe if you want to commit 3 hours during the day to doing some quick trading. So you'll need a different system. So you have to make that trading system suit your time situation. The last thing, the trading system, is that it has to be profitable, quite obviously, and that's something you're going to find out by doing some testing after you've established the system. Certainly if your basis is on sound principles that you've learnt in technical analysis, then there's no reason why it can't be profitable. First thing you have to do for your system is figure out the ideas. What's your concept? Do you want to base it around moving averages? Are you looking for a double crossover to give you a signal to go into a trade and with price crossing or moving averages? How do you want to make it work? Is it with moving averages, or do you want to use indicators? Looking for overbought, oversold situations, and once you've found them, perhaps looking for a candlestick signal that will give you a trigger to go into the trade. Now, of course, there are pattern-based concepts, they're fine. Reversal continuation, most common ones, the head and shoulders, the W and the triple tops, but head and shoulders is the one you see a lot, and that can be a trigger for you to go into the trade when you see from other indicators that the market is ready for a reversal. Or you can use candlestick patterns, or you may find that it's certainly interesting to go into the Ichimoku charts, because they can tell you an awful lot about the conditions in a market and the security in that market. And they can certainly give you indicators of when to trade. So you have everything you've looked at so far you can use for the concept, and you need to decide what it is that appeals to you. Perhaps when you're going through one of the previous modules you said, well, yeah, that looks good. I like that. Moving averages, for instance, you may go back and say, yeah, I'm going to try writing my system based around those. Once you've decided what you're going to use, try out, then you need to make up the rules that you're going to adopt for it. They've got to be unambiguous. You've got to have something that you can give to a kid and say, follow this, and we'll see what happens to confirm it. In the module, I'll actually say that in the entry, people worry too much about the entry conditions, as if that's the one thing that will settle whether they make profits or not. This is not really true, obviously. We want to pick a good entry, yes, best entry if you can. certainly, but don't worry about it. It doesn't count for more than 10% of the profit. The entry, you can do that on a moving average crossover. You can do that one breaking through resistance. You've got support and resistance in a sideways trends, for example. You may look at it in one of the oversold situations, say one of the oscillators coming back to say 20% level, that may give you a signal for an entry. Certainly if your oscillator is diverging from a trend price, that will give you a warning symbol that perhaps you should look out for an entry in a candlestick pattern. It'll give you one to watch out. Certainly your rules will have to cover position sizing. We've covered this before, but position sizing, briefly, you should put more than 10% of your available account into any one particular trade, just in case something goes wrong and you don't want to use more than 2% of your account on any other particular trades that you do. And finally, the final section of the rules is the exit. When you're going to get out of the trade, that is may be set if you're trading in a range and buying when it hits support. You may sell when it gets to resistance, or you may want to put a trailing stop so that when the price has a little setback, it'll kick you out. So those are basically the three aspects of a successful trading system. You have the entry, where you're going to start your trade, and the position sizing, how much you're going to put into it. And the exit is where you're going to take it out, and where you're going to minimize your losses if that happens to be a losing trade. That doesn't happen fairly often. You minimize your losses. You formulate rules, you make them unambiguous. Say if you would hand them to another person, they'll be able to follow those. So after you've done that, you check your system. Now depending upon your system, you may print out a few charts, different securities, and just follow them through to see how the system plays out. You want to get a feel for what happens, and certainly see if there are other ways that you can tune up a little bit so it'll work better, but basically you're getting a feel for the system by going through it quickly with a few printed out charts. The main part of checking the system is of course back testing. I do encourage you to spend your time to work out how you do this for yourself, because that will give you enough flexibility to change the things later, but certainly there are people who will set that up and test for you, who know about software and can pay them to backtest this for you. But there are user groups as well, so if you want to try it yourself, it will help you if you have a particular problem. Go to the user group and ask, and you'll find some very helpful people out there. That's really where you get hard numbers. If it'll come out in profits, you'll see it come out. So it's basically the back testing system. But once you've done all that, you'll probably want to paper trade as well. Some people say it's not worth paper trading because it's different, and it certainly is. It's not emotional. Paper trading, you can pretend all you want, but it's not real money. You're going to feel like the lesser the tension and the stress than you would normally have if it was real money. And you can obey the rules you have, trade your system, but once you've got real money at risk, you may find yourself tempted to bend those because of fear, greed, and emotions. But I'll certainly suggest paper trading, if nothing else, to make sure you really know the system and know what to do in every circumstance, so that when you've got real money, then you can react and do what you want to do correctly. When you start trading, I heartily recommend that you keep yourself a journal. Put your notes down when you went into the trade, how you further ventured. Just put down everything to do with that trade. The price, obviously. Print out the chart and say this is the signal I saw, and whether the trade wins or loses doesn't mean that you've got it right or wrong. As long as you've traded your system correctly, then you've got it right, and the market may have been rumoured. So don't look to change your system just because you've got that. You can certainly review your journal and see if there are some consistent ways that you can improve what you're doing. Change your system for that. Don't rush to change your system if it's a proven and effective system. But do bear that continual improvement is in your own interest. When you're trading, discipline is a very important thing. This is a thing that will get you through your emotions. It's something that you will have to learn. There's no substitute for it. You have to focus on your system. You have to trade your system, plan your trade and trade your plan. and you need discipline when you do that. And of course, one of the prime directives when you do your trade is to preserve your capital. That is to say, you get out of your losing positions quickly, cut losses. That is the thing, really. That'll take you down from the path if you don't obey your rules to preserve your capital. Now it's time for a recap. In general, of all the things we've covered in technical analysis. So we've talked about trends, we've talked about trading with trends and how that'll probably be the least risky way of trading. You can do some things like trading counter trend, which you know it's fine if you know it, but certainly you want to look for a trend. You may want to cast a long-term moving average on your chart just to recommend that it's a trend and not just some minor retracement. And in that respect, you probably want to look at some different time scales for the chart. You want to look at some larger time scales to confirm your trends and to see if there are some resistance levels out there before you go to the shorter time scales to time your trade. Lines on charts, I just put that in there as a general heading that counts as support and resistance if you have horizontal lines that your price is going between. It also counts as a trend line and if appropriate, trend lines and channel lines parallel to the trend lines and on the other side of the prices. Then it also covers things like Bollinger Bands. Remember, those are the bands that move with the volatility of the price, and they can give a pretty good price to how far the price would go. So prices tend to go along the band, so they're also pretty useful lines on the charts. Expected levels. By that I mean retracement levels, for instance, either using Fibonacci retracements with 38, 62 or 50% in the middle, or you can use 1/3, 2/3 retracement levels. But an expected level also means that when you look back on your charts, are there any places where it hits supports and resistance a few times at that level, and you might find that that comes into play at the future. Moving averages. We talked about moving averages can cover a whole host of things. They can give you signals for trading. They can show you trends. Moving averages in all sorts and lengths of time can give you a lot of information. Patterns. By that we mean all sorts of things again. Head and shoulder patterns, double tops, double bottoms, and those are the general patterns in the Western charts. Again, you can look at candlestick patterns, and there are many patterns in the candlestick and dojis that denotes indecision. You would normally want to see the next candle happen so you have some sort of information. For example, if there's a reversal, you would also want to see an oscillator at extreme position to suggest that something is going to happen. Patterns you use those to give you the timing for the trade. And I suggest oscillators too. I've covered oscillators if you find they've worked for you to find the time frame of the trading and the financial security of the trade. And certainly don't want to do more than a couple of those to find the ones you want. So basically, trading does have some rules. You preserve your capital. If you don't preserve your capital, you won't be trading next year. It's not as simple as that. So the prime directive is not to make a big profit, but to preserve your capital for trading. Cut your losses. It's very hard. We've all been there. You know the price comes down to just below what's your stock index, and you say, "Yep, fine." And then you stay out on your stock in the market because you think it's going to go back up. After all, you took your trade because you thought things would go up in the first place, and then you wait. The next day it plummets some more. We've all been there, and if you lose not 2% as you calculated from your trade, but you lose 10%, it won't take you many losses for you to find yourself in some difficulty to recover your position. So be brutal in cutting your losses. The opposite of that, of course, is let your profits run. It's too easy if you've had a lot of losers to say, I've got a profitable position, I'm going to quit for the day, take my profit and feel good this evening. You've got to let your profits run. You need to make your wins bigger than your losses. You may only have half of your trades win, but you can make a good profit as long as you let it run a little bit more and your wins bigger than your losses. That's basically it. 3-to-1 guideline for reward to risk. Some traders will take it down to 2-to-1. I don't recommend that. You want to see potentially 3 times as much made on the trade as you're prepared to lose on it. So that's a good rule of thumb. Don't even bother trading if it's one-to-one, because even if you think it's going to go up, chances are it may not. In that respect, don't force trades. Don't try to find trades where none exist. It's easy to think that you're not working at it. If you're not going out and in, it's easy to think that your money is wasting, sitting in your account, and is not actively traded in something. But sometimes the trades are there, or the trades are only half there, and you don't really want to take the trades that are half there. The more risk and you want to stick on your plan, stick to what you look for in your trading system as an entry, and don't try to force it. You're working just as hard when you're sitting there watching your screen waiting for the entry conditions to be satisfied as you are when you have money in there. Don't force anything that's not in accordance with your gut. And finally, don't forget to preserve your capital. Again, prime directive, and when you're trading, preserve your capital, and you can keep on trading and keep on learning and keep on getting better at it. That covers trading in general, technical analysis in general, and the next series of modules are going to look at different markets. The next module, module 13, is stock market, and the modules after that we cover futures and options and other securities. So I look forward to talking to you again in the next module, which is module 13, about the stock market. So goodbye for now.